without further ado, I'd like to introduce the Tom Sosnoff. I'm sure you guys all know who Tom is. For anyone that doesn't, he's the co-CEO of Tasty Trades and founder. We all love Tasty Trades. I'm sure you've seen us all post our all videos in there from all their different statistical studies and their great educational content. And Tom also built, for some of you may not know, he helped build the Thinkorswim platform, which I know a lot of you guys also use, and he sold it to TD Ameritrade. And now he has created the tastyworks platform, which we use at Portfolio Kings. We think it's the best platform for options trading. They also have crypto on there. We'll have questions related to that. And if you guys have more questions about the program, we can, there's no one better to ask than Tom himself. And for anyone that isn't on Tastyworks, if you want to join, please use our code Portfolio Kings. And yeah, we'll hopefully by the end of this, you'll be convinced to use that brokerage. But yeah, thanks Tom for joining us today.
Sure. Happy to be here. Sounds like fun.
All right. So
you want me to go ahead and ask some of the first questions?
Yeah.
All right. So the first question we have, again, thank you for taking the time to come speak with our members. Everyone's super grateful to meet you. It's an honor. The first question we have is, we all know who Tom Sosnoff is, but if you could give us a little history about your life, just to catch some members up that don't know you formally, how you got into trading, and how, you got to the level of success in the industry that you're at now.
Well, it's, thanks guys. And thanks everybody for logging in tonight and listening. And like I told these guys before we started, nothing's off limits. So you can fire off any questions you want. I mean, I'm kind of a trading junkie. So this is my 40th year in the business. I know you guys are all, 19, and I started when I was 22-ish, around 22. So I'm 23, maybe somewhere in there. I'm 64 right now. So it's been 41 years. And I got into this business as a fluke, actually, because it was the only job I could find. I'm back in the day. But I started trading in 1981 on the floor of the SIBO. 1999, 2000, we built Thinkorswim. I just had a hunch one day. I was standing around the pits, and I traded in the pits for 20 years, and I was kind of like, after 20 years, I was like, all right, it's time to try something new. We made some money. Let's roll the dice, and turned to a buddy of mine who I was partners with at the time. We owned a prop firm, and we said, let's build this crazy company. I had an idea to build Thinkorswim, and we just took a shot, and it kind of worked out. And we were a public company. We sold it, and we got bought out in 2009 by TD Ameritrade during the kind of the meltdown, for, I don't know, like $750 million. It was a crazy amount of money for us. And everything changed, and we built Tasty after that. And recently Tasty Trade we merged with a company over in London. So we're going to expand it globally over the next, 5 years. And it's been an amazing, run. That's it. Basically I build software and I trade. And I talk a lot about trading to a lot of people. So I'm a promoter who likes promoting the industry. So I don't like to be like a classic CEO. Even though I'm the CEO, I kind of leave running the company to other people, and I prefer to promote the business and really build software.
So I was wondering, I think the statistic is like 90% of traders don't make money trading. So obviously not only have you made money, but what do you think you've done to just be at such a high level in this field and be so successful in this field?
Well, I think if you go back to the trading floor era, which is over now, there's no more trading floors left really. Essentially it's all servers now. But back in those days, it was really about maybe 5% of the people survived, And like, I don't know why I survived and somebody else didn't. Like, you really don't I mean, in the business, sometimes it was usually like, you know, it was usually like temperament and speed. I know speed sounds kind of weird, but it was your ability to do math in your head really fast, make decisions really fast, and not, and, you know, over the years, avoid doing something crazy stupid. I mean, that would blow you up. So about 5% of us kind of survived over the years. But then in the public business, in the retail business where we're in now, the success rate is much higher. You know, there's somewhere around 80% of most people survive. There's about 16% which really excel. And there's about, you know, 15 to 20% which don't make it at all. And everybody else falls kind of in the middle of a distribution curve. And in that distribution curve, like, you know, half the people are a little bit above average and half the people are a little bit below average. But, you know, with an outlier group, you know, on the upside of about 15%. So it's kind of a really interesting dynamic, but the retail space is pretty random and pretty opportunistic, I think. You know, fees are really low right now. Commissions are virtually non-existent. The access to the markets is really fair and it's a level playing field. And I think, you know, with like the content that we produce and all the stuff, like the stuff that I'm learning today still as a trader is stuff that I never knew in, you know, last couple decades. So you guys have a huge advantage starting young and doing the stuff you're doing. It's amazing.
Let me hop in here real quick and kind of go backtrack a little bit into your experiences in the pits.
Yeah,
Now,
sure.
You said that about 5% of you survived. Are you familiar with the 2009 documentary Floored?
I've never seen it, but I am familiar with it.
Yeah. So in that documentary, they basically what they highlighted about the pits were that it's a whole different dynamic in the sense that you were trading against other people, and it was more apparent who was winning and who was losing. You know, if you're on the other side of the pit, taking the opposite side of someone's trade, and you know, it went against them, you were directly profiting off of that. It seemed like it was much more of like much more raw capitalism, if you will, much more like of a less statistical approach that the Tasty trade is based off of today. More
well,
of like
you got to remember,
trade.
At the time, it was the last frontier of, like you said, raw capitalism. It was a free market at its finest. There was no such word as entrepreneurship 40 years ago. In fact, when I went to college, they didn't even have a business degree. Okay, it didn't even exist. I mean, you could take, if you wanted to, I guess you could take economics, but there was no such thing as a business degree, and there was definitely no finance degree. And so, you know, but there was the concept of capitalism. But you have to remember, throughout the 70s, it was a really rough time in America. I mean, you know, the Vietnam War was very divisive in this country, and after the Vietnam War, there was, you know, an oil embargo, there was a recession, interest rates were, you know, almost 20%, and the country was very divided. And there wasn't necessarily kind of this concept of entrepreneurship. So when I got to Chicago in 1980 or 1981, it was, there wasn't many, like you said, frontiers of capitalism left in this country. I mean, there really wasn't, especially for young people with no money. Like, none of us had any money. So, you know, we were starting out with, you know, $1,000 or $2,000 in our pockets. We had nothing. And it was an opportunity. Today, nothing like that, we've come full circle and nothing like that exists anymore. But back then we weren't really trading with each other. Like, if the four of you guys were in the pits together, you would never make a trade. Like, you would never trade with each other. It's almost like, imagine, you guys probably play poker or something. Imagine you go to play poker with, you know, with 6 of your buddies. It's hard to play poker with your buddies until like somebody else sits down at the table who you don't know. And in the trading world, in the pits, we would rarely trade with each other. We would only trade with what they call public order flow, just orders that came into the pit. So there were traders and there were brokers, and the traders traded with brokers. They didn't trade with each other. I might close a trade with you, but I would never open a trade with you. So that's kind of the nature of the business. It wasn't like Florida, if they made it seem like that, that's not really how it worked. It wasn't like, I traded in a pit with 450 guys in the S&P 100, almost 450 guys. There was a couple women, but it was mostly 450 guys. And everybody was like a big giant alpha male. Like every single personality was the same. Everybody was a tough guy. There was no, you didn't survive for like even an hour if you weren't, like if you didn't have thick skin and it was, and you couldn't listen to the bullshit and you weren't willing to stand up for, it was a brutally, it was a brutally tough world. I hired probably about 200 traders over a 20-year period that worked with us on and off. And I would say, some graduated college, some were straight out of high school, some were professional football players, one was a professional wrestler, a couple had, one had a PhD, one had an MBA. You had no idea who was going to be successful and who wasn't. It was almost impossible. So they made it seem like the floor trading era was kind of, spectacular in certain ways. And in some ways it was a great life, but it was also, we made a lot of money. We spent a lot of money. It was kind of a crazy life, if you can imagine. In fact, when I first got to the floor, my dad was a civil rights attorney and my mom was an art teacher. And my first year on trading on the floor, I was 23 or 24 years old. And I made more money than both of them combined in their last 3 or 4 years of work. And I was too embarrassed to tell them. So, I couldn't even explain to them what I did for a living because I thought they would think, I stole it or something. It was insane. So, but you live a certain lifestyle and it was like, you burn through it. It was a little bit of a crazy life, like an athlete. When I'll tell you one story and then I promise I won't go off on a tangent anymore. But when we first started trading in Chicago, the Bulls had just drafted Michael Jordan, and he was a rookie, and it was 1984, and they couldn't sell any seats at the Chicago Stadium before they drafted Jordan, and so when they drafted him in 1985, they decided they're going to sell floor seats, and they couldn't sell them at first because I think they were $75 a ticket for floor seats at the time, and they couldn't sell one of them. So they came to all the trader offices down on the Board of Trade and they knocked on door to door the Chicago Bulls. And finally they got to our office and they said, we'll sell you tickets and you can sit anywhere you want on the floor. So we took the 4 seats next to Jordan at the end of the bench. And then when so this was his second year in the league. We actually had the seats during his rookie year, but sometime during the second year in the league, after we've been talking to him back and forth for like a year, because he was just a kid, a couple of years younger than us. He leans over and he says, someday I just want to make as much money as you guys. And we laughed and said, don't worry, Michael, someday you're going to make a lot more money. And like not even knowing at the time, he'd signed like a 4-year, $500,000 deal, like $100,000 a year. It was crazy. But, that just goes to show you how nuts it was, back in those days. So.
Wow. That's an amazing story. I'm going to pass this off to Ivan. Did you want to take over?
Yeah, let's get into some of the members' questions. Thank you.
Sure. Fire away. If I ask anything, I don't care.
Awesome. So obviously here at Portfolio Kings, we're huge fans of selling options. That's the strategy that we employ. And we really love the strategy just because obviously, the statistical edge and there's multiple ways to make money, but for some of our newer members that have just been catching on, kind of learning the ropes of premium selling, oftentimes we get the question of, oh, is this too easy to be true? Is it too good to be true? And why aren't, other people trading this way? So if you could answer that question, that'd be awesome.
Well, first of all, nothing is easy at all, ever. You got to remember, there's no theoretical mispricing in the world of anything in the financial world. There is so much money out there seeking active returns, and risk-free returns are zero. Passive returns are whatever they are, for index funds, so nobody cares. And then active returns are obviously whatever you can make them, but they got to be some multiple of passive returns. And so when you say, my approach to investing as a retail as a retail customer is I like to force the stock to beat me rather than me try to beat the stock, because I think it's too hard, whatever the underlying is, whether it's a stock, whether it's an index, whether it's a future. I think it's very hard, to predict market direction and to actually, know what's going to happen next, especially when you're trying to be capital efficient at the same time. So we take kind of the contrarian approach, or the opposite approach, which is let's create a mechanical approach to trading where we can, because markets are so liquid and they're efficient and fees are so low, let's do what has the highest probabilistic outcome. Let's sell that instead of buy it. But at the same time, let's keep our position small. We know we have no theoretical edge, because who's ever buying it from us knows exactly what it's worth. So there's no theoretical edge in selling it, but there is what we call a mechanical edge, or there's an opportunity for mean reversion and implied volatility to potentially pay us if multiple things don't happen, which is what I like. I like to create a strategy where even if I'm not right directionally, I can still make money. And one of the things that I think most people don't understand about self-directed finance, especially in the active world, is most people think that you have to be right. And I think one of the coolest things about trading derivatives, specifically gray derivatives, like stocks are black and white, futures are black and white, because if you buy them, they got to go up. If you sell them, they got to go down. But in the world of options, it's a gray area. And so what I like is products that are strategic, where if you're right, maybe you lose money, but if you're wrong, you can make money. It just gives you so many more, there's so much more optionality to it that's kind of, Ivan, that's kind of what we play for. So it's not that there's a statistical advantage. Okay, it's just that what we call it is kind of like a mechanical approach. So you're not disadvantaged, you're not advantaged, but you're not disadvantaged. But what you're doing is you're setting yourself up for a very high probabilistic outcome, meaning that you're going to win more times than you lose. You just have to figure out how to turn those wins into more money than your losses. Like if you win 8 times and lose 2 times, that's cool. And that's what you should do. But you got to make sure that those 2 times you lose don't eat up the 8 times that you win.
Awesome. Yeah. And bouncing off of that, I know some of us in here are more familiar with some of the more advanced spreads. I know some people have been learning the ropes of Strangles, for instance. I've personally enjoyed watching you trade Strangles through the tastyworks platform. I'm always seeing what you're doing. And I had a personal question about, some of the criteria you use for your Strangles, because I mean, at least from what I've seen that you've traded them a bit more aggressively. You're obviously always rolling them, and you seem to get pretty tight pretty quickly. I don't know if you remember, I mean, you've been trading GPS. That's something that I've been following, just, watching what you've been doing. And you've gotten pretty tight pretty quickly in that. And I was just wondering, your rationale.
Well, that was a stock that had a huge run up. I mean, it's kind of like whatever, 30, I don't know what it is right now, but like $32, $33 stock that, it was like $30. It had a huge run up to like 36. And then it backed off, back down to again, like 31, 32, whatever. And, Gap's one of those stocks that it's not a great trading vehicle. I only traded it because I was, doing this show with these 2 TikTokers who I was teaching them how to trade, and so they were trading it. So I said, oh, what the hell, I'll do something there. And the second thing was it had a really high IV rank. So I think the IVR in there got up to like 40 or 50 once. So I put a position on. I did a normal strangle at first. Like let's say my original strangle was the 30-36, right? Sell the 30 puts, sell the 36 calls. Well, the stock, as it ran up to 36, I kept rolling the puts up to, up towards 36 to neutralize my deltas in there. And then when the stock went back down, I took the calls and took those things down to like 31. So, then I was inverted in there, which is fine. I don't really care because I picked up premium all the way along. I mean, in the end, it probably turned out to be a small winner. But instead of getting whipsawed, as volatility came in there, like I said, it was a small winner. I aggressively managed it. and it was an okay trade. Not, no complaints. I love doing stuff like that though, because that keeps me fully engaged in what's happening.
Awesome.
Did you just
We had another question from one of our members. He said, I know you trade $100,000 show account. How many positions do you like to have open at a time, and how much buying power do you like to have available?
Okay, well, we only show $100,000. That accounts actually, to be fair, that accounts probably, well, it's a minimum of a few million. Let's put it that way. So it's not a $100,000 account. That's the max we show on that follow page. So that account's probably, at least a couple $1 million, $3-4 million. And it's, I usually keep about 80 to 90 different underlyings, and probably 200-300 position, maybe between 200 and 400 different positions in those 80 underlyings. But you got to remember, it's all I've ever done my whole life. So like, you think it's a lot, but it's really not. Like, it's like, I'm kind of a one-trick pony in that sense. So, if you think about it, like, if you were like a professional golfer, if you've ever listened to some professional golfer talk, they can remember every hole on every golf course they've ever played and whatever they shot. Or if you ever hear like a professional, if you hear a retired like baseball player, he'll say something like, in 1982, I struck out swinging on a slider, against some pitcher. Like, they'll even remember every pitch. It's the same thing for traders like me. Like, we remember every trade we ever made. And so, for me to remember a couple hundred positions, it's nothing. I used to remember like, 10 or 20,000. Now it's only like, a few hundred. So it's not a big deal.
So so with that, like, following up, how one, like, for us that, aren't professionals, haven't been
Sure.
in that long, how many would you recommend? And then you're like, how much buying power do you usually like?
Well, assuming that listen, I don't know how much money you have, but you're young. So I'm going to assume that you haven't, you're still building up your wealth. Okay. And in the easiest way for me to say this is like, let's take a smaller account, like somewhere between, let's say around $5,000. Okay. Is that fair kind of number? And if we're looking at an account with like, let's say 3, 5,000, 10,000, somewhere in that range, 2,000 to 10,000, let's say. I think you can easily have, 10 or 11 positions on. Like, I have these two accounts with these two kids. They're 22 and 22 and 24 that I'm doing the show with. They're like financial bloggers and stuff like that, and TikTokers. And I like them a lot. And they each have a $5,000 account, and they have 12 and 13 positions on, each of them have 12 or 13 positions on, and they're only using about 65 to 75% of their capital. I think that is a reasonable number, like to have somewhere between, let's say, 6 and 10 positions on in a $2,000 to $5,000 account, with maybe using up to 75% of your capital. I think that's fine. Some defined risk, maybe 1 or 2 undefined risk. Maybe throw in a crypto position, maybe throw in, something else. I mean, it's really up to you. The nice thing about Tasty is we don't limit you as what you can do based on the amount of money you have. So unlike other firms where you can't do certain things, we don't care what you do. No matter how much money you have, we let you do it.
So piggybacking off of that real quick. So with an example of, say, a $5,000 account, and you're using 65 to 75% of your, maybe I'll go a little bit larger, between 5 and 10,000, let's say 10,000.
Okay.
I personally don't think it's too hard to accumulate that much money, but with $10,000 and you're using 65 to 75% of your account in positions, sure, what should your thetas look like? About 70, 80 thetas a day? Is there a range that should be put in? I remember watching
I mean, we've done a lot of different studies on this, and if your account size is if you remember, when you have a smaller account, your numbers are going to be a little bit exaggerated, because when you have a larger account, the numbers obviously will scale down. So your theta numbers will be a little less, but What you want to make sure is that your theta number does not exceed, 1%. That would be on the high end. Like if you have a really large account, you don't want to exceed 0.2 or 0.3%. But on a smaller account, 1% would be kind of the high end. So you're saying on a $10,000 account, I'd like to see you somewhere between $50 and $70 a day, $30 to $70 a day, somewhere in that range, depending on the level of implied volatility across the board. Like implied volatility is cheap right now, so you're going to be on the lower end because you don't scale up until there's more opportunity. But so let's just use 10,000 because people can back down from that, and just, do the math and extrapolate the math. But the max I would say theta wise on a $10,000 account would be $100 on a daily basis. I'd rather see you in the $30 to $70 range, depending on the amount, the level of the VIX or the level of implied volatility. But if you're in the, 40, 50, 60 or $70 range, that's fine too. I just wouldn't go over 100.
That's exactly what I had in my mind. I was just wanting you to confirm it. That's what I had told people in our chat, that if you have X amount of dollars, I'd say 10,000 as an example. Yeah. I was saying, that's a good range to set it up as. And I was just asking that question. Yeah.
And then, now, if you had a $100,000 account, I would say that I'd like to see no more than about 0.3% or $300. And if you have $1 million account, you'd probably be in the area of 1 to 2, 0.1% or 10 to 20 basis points. But smaller accounts, the nature of this business is that if your account size is a little bit smaller, you have a few more challenges because you're obviously challenged by the amount of capital you have. You're obviously going to use a higher percentage of it, so you have some additional risks. But you guys have to understand, as young as you are, and with the experience you're getting right now, there's not a course you could take in all of academia that's going to give you the same experience. And I'm not saying for one second that you shouldn't be all in on, on university studies and the maturity and the networking that you get from going to school. I don't want to say something that I think school is incredibly important, and I think grad school is also, and everything else. But there's certain areas of finance that are not really covered. And what you're doing by trading is you're covering certain areas of derivatives and finance and statistics and probabilities and also decision making that you would never experience, mathematically not possible to experience in any other aspect of your life. So every one of you that's young and on this chat today, your ability, if you make, I don't know how many trades you make a year, but let's say you make somewhere between 250 and 2,500 trades, whatever that number is, your ability to make decisions that will impact the remainder of your life is extraordinary. When you asked the first question tonight, like talking about my career, the success of my career, I can trace it back to one thing, which is floor trading, but not what I learned on the floor about options, more about decision making and how important it is to just be able to process stuff in your brain. Like the reason certain athletes are great, like Tom Brady or Jordan or somebody like that, it's not, in the case of like Brady or something, it's not that they have incredible physical skill that somebody else doesn't have. It's that they are able to process things that other people can't process as quickly as other people can process it. And your ability to make decisions removes something that they call an economic bias. So economic bias is most people's inability to make decisions. Like, I don't know what kind of pizza to order. I don't know what kind of I don't know what I want on my hot dog, whatever it is. But most people go through life without making enough decisions so that the speed of decision-making is too complex a topic for them. For you guys, your decision-making speed, because of all the trading you're doing now at this age, is going to be, nobody's going to be as fast as you guys. And nobody's going to be able to assess risk and probabilistic outcomes as fast as you'll be able to. So for that, you're going to be significantly ahead, and you're going to be able to differentiate yourself from your peers. And that's really important.
Thank you so much for covering on that. I'm going to pass it off to Ivan again for another question.
I going. So this is kind of related to what we were talking about, the account sizing stuff, and and we actually have had this as a question when people asking about using tastyworks compared to some like a free program like Robinhood.
Sure.
So with having more like position, like what would you say to like someone asking about having more positions? That means more fees and stuff on a paid brokerage like Tastyworks.
Yeah.
Well,
The
the fees are so small. I mean, remember, stock at Tastyworks is free anyway, and you can't do the stuff like we have a saying, like sometimes you can't afford free. I know that doesn't mean as much to you guys right now, but when you go through life, you'll see it. Sometimes you simply can't afford free, and in the case of listen, Robinhood changed the industry, and in a way that I didn't actually think they were capable of, but they were, in the sense that they engaged a lot of people, especially young people, Gen Zers, like you guys, which is awesome. But the app is really basic, and the ability to you can't short an option on there. You can barely do a spread. It's a pain in the butt. It's they're so limited. You can't trade a future. I mean, the things that you can't do in there, you cannot be strategic. So it's basically they're leading you down a certain path, but they're not taking you to where you have to go to be successful. I would guess that, if this market ever turns around and it's not a bull market anymore, there's not going to be a lot of people that are very successful at the Robinhoods or Webuills of the world. You need a platform that's indifferent to product, and you need a platform that is indifferent to strategy, which Tastyworks is. You get those kind of other platforms, and they're too restrictive, and they're not strategic in nature. So for me, it's cool that they got a lot of people engaged in the business, but it ends right there. It's not, let's put it this way. I'm glad that they exist, but it's not tradable. Their platform's not usable for me.
So we have
Someone just asked in the chat if you have any idea when Tastyworks will be available in Canada.
Hopefully by the end of the year. We're trying to get approval for our clearing firm now. Tastyworks is all but approved in Canada. We're just waiting for a clearing document to be signed by the regulators. So I just did a podcast this afternoon with a Canadian guy, and he asked the same question, and we're in front of the regulators there basically every week, but we're waiting for Apex, which is a clearing firm. So in this business, brokerage firms do the front end and clearing firms do the back end. And we're just waiting for a clearing firm in Canada to be able to accept us. It should be soon.
So awesome. For someone that in Canada or outside the US, what brokerage would you recommend to them?
In Canada, the only two brokerages that you can use in Canada, the only two brokerages I would even consider in Canada are Questrade and Interactive Brokers. But trust me, they both stink. They're both very mediocre, but I would use either Interactive Brokers or Questrade.
Awesome. Moving on, we got I don't know if this is a controversial question, but we do have a lot of members that always come in asking us about TA. We have some, Sam, for instance, is very interested in TA. And we had a couple of questions regarding what your view on using technical analysis is to trade.
So I grew up as every floor trader in Chicago grew up without ever using technical analysis. There's no such thing. And, you have to remember, all the people that make all the money in this business, technical analysis never existed. So all the market making firms, all the prop firms, all the floor traders, everybody that makes the most money, the Citadels of the world, the Simplexes of the world, the Wolverines, the Susquehannas, every one of the high frequency market making firms, nobody uses any technical analysis. Every floor trader, no floor trader ever used any technical analysis. And so I traded for 20 years and never even saw a chart. Nobody did. There was no such thing. All of a sudden we built thinkorswim, and these customers were like, hey, where are your charts? We're like, what? Nobody uses charts. They're like, yes, every customer uses charts. And we're like, no wonder everybody loses money. We had no idea. So we built all these charting platforms. I built some really cool ones that at Thinkorswim just because customers wanted them. And I built some cool ones at Tasty too. But the problem is that, you know, I've never believed in technical analysis, and I never will. To me, I don't care what happened in the past, because I believe markets are forward looking, and I don't believe the past has any relevance to the future. Like, I'm not a person that believes that just because something, like, I don't believe price is mean reverting. In fact, I know price does not mean reverting. The only thing that's mean reverting is math. And the only math equation in trading is implied volatility. So when you look at prices, historical prices, like, I don't even understand why anybody, you know, even believes in technical analysis, but I'm okay with it as an engagement tool. If you want to look at a picture of what a stock has done, go look at a picture, but don't try to formulate an opinion on what a stock is going to do next based on what a stock has done in the past, because there is no relevance. We did a couple of great pieces of research. I have this really smart mathematician that works for us. His name is Jacob Perlman. He does these segments called The Skinny on Option Math. He's a brilliant kid. And he did a piece a couple of weeks ago on Brownian bridges, and it was amazing. And it talks basically on how you can essentially create, out of any random movement, you can create whatever kind of chart pattern you want to say, whatever you want it to say. And basically, it's virtually impossible not to create something that looks like whatever it is that you want it to look like. I build charting packages because customers want to see pictures, because that's the way they learned, and that's the way investor education was taught. But the reality of technical analysis is an engagement tool, it's fine. As a money-making tool, it's completely random. It's all garbage. Complete random.
Yeah, so I mean, here, sorry, not to interrupt or anything, but
No, go ahead.
you know, I've been you know, I mean, I do options. I love options. I actually
Sure.
started, you know, trading. I started doing options, but I ended up deviating a little more towards technical analysis. And obviously, you're more experienced. I trust you. You know, I'm
No, that's
not taking
cool.
your word for
Whatever
granted.
works.
So, I mean, I guess my approach to technical analysis is really statistical as well. And I've read the works of, you know, a lot of the old technical analysis guys, Wells Wilder, all the old OGs, and you know, even Steve Nissen with, you know, Japanese candlestick techniques, which were really old. But you know, when it comes down to at least this approach I take is more statistical. And so there's this one guy, Thomas Bolkowski, he was a statistician, and he does a lot of experiments on the, you know, these chart patterns, and he goes back, you know, pretty much all-time history of the charts, and he looks on every stock, every pattern, and he sees, you know, how often is this performing. And he found that it is pretty much like a coin flip, you know, just like anyone says. And, you know, even, you know, let's say it is a coin flip. Let's say that, you know, you see a triangle, it's 50-50, whether it'll go up from it or down from it. You know, I totally agree with that. But, you know, what if we took the trade, you know, with a small risk and leaving a large reward? You know, let's say we had like a 1-to-3 risk to reward, and, you know, we were insured that 50-50 from this level, or maybe, you know, not perfectly guaranteed, but, you know, to the same guarantee that the options, you know, deltas and options statistics can work.
I mean, if you believe, Sam, that there is pot odds in your favor, which I believe a lot of times that's the case, but I don't believe it based on a chart pattern, even though we may get to the same conclusion looking at a stock. Like if I look at a stock, like I'll just give you an example of something I looked at today. So I was trading Target at the end of the day, and Target is like TGT. It's a stock that it hasn't had a downtick. It's been hyperbolic as of late. Definitely. And so I sold a bunch of naked calls in there this afternoon. Now, the only reason I sold some calls in there is because at the levels it got to, I'm thinking to myself, hey, I really like the pot odds in here. I like the chances of this stock. I know it's 50-50. If it's going to continue to go higher, it's going to go lower. But I like the pot odds that if it goes lower, it's going to go lower by maybe 2 or 3 times more than it's going to go higher. That's a pot odds play for me, but it doesn't have there's no statistical relevance to that. It's just a completely subjective, like there's no statistical significance to me thinking that it's a pot odds play. It's just a subjective opinion. And whether you get there through technical analysis or you get there through something else, there is no such thing. Like what we do from a quantitative side, and the reason that we're so into math and numbers is we're just trying to look at things probabilistically based on implied volatility, which is forward-looking and tradable, as opposed to historical volatility, which is backward-looking and not tradable. So let me give you an example. So XYZ stock is trading for $100, let's say, and the implied volatility is 30. So let's just say that that means the expected move over the next month based on that liquid and efficient implied volatility number, because that's based on the bid-ask differential of all the options. Let's say the expected move over the next month is $10. I use that context of that expected move to create an option strategy at the outer ends of the expected move. So that's using forward-looking real numbers, not telling you what the stock's actually going to do, but what the stock's projected to do based on where those options are actually tradable. So I'm not making a subjective decision based on direction or anything like that. I'm making a strategic decision based on real-time expected move where something's trading. Now, it only has about a 70% chance of being accurate, so it may or may not work. But that's how we use math and statistics. Like, I'm looking for optimizing statistical significance based on forward-looking numbers. I don't care what's happened in the past to give me some, whether it's a Fibonacci retracement or it's a stochastic or it's a spinning top or an abandoned baby or whatever, Japanese, candlestick term you want to use. Right. Gravestone doji. I mean, I've done it all, man. We've been, we've done it all over the years. And so, I mean, anyway, that's the way I look at it.
Okay. Yeah. So, I mean, when you were on the floor, like, did you never kind of, I guess, notice that maybe like for a few minutes or a few hours, like a stock was kind of stuck at a specific, level, and then it just started running after that, after it kind of broke a kind of seller wall or buyer wall, I guess. And that, that'd be less, that's something that would be probably more psychological than,
Yeah. I mean, most of my career, I traded index products, so I didn't trade a lot of equities. The one thing I think that people don't realize as much is when we were floor traders, you didn't, even though you could have theoretically walked around and traded any product you want, you really couldn't. Like, you basically had a home, and wherever that home was in whatever pit you traded in, that's where you spent 99% of your time. Right. So like you couldn't really go off and trade something else. And we didn't have electronic systems. Yeah. So we didn't have access like through we had handheld, like really old handheld computers, kind of. They were like outdated, tablets, but you couldn't trade other products with them. So we were really stuck in trading the product that we traded.
Okay.
All by hand.
Right.
Awesome.
That's great.
Yeah. I don't know if there's more questions. Sam.
Yeah, I got a good one here. Just tying in kind of with what the Fed is doing here at Portfolio Kings, we like to analyze like economic data a lot, look at what's going on in the broader markets in terms of monetary policy, and tying that in with what's been going on for the last year. We have a member who's asking, what is your personal market outlook right now?
I should preface this by saying I do not only do I not believe in technicals, but I don't believe in fundamentals either. So one of the things that you've noticed since you guys watch Tasty is we're no fundamentals, no technicals, no news, no guess, because I don't give a rat's ass what other people think, and I don't care what the news says. And because news to me is irrelevant as well, because everything's already priced in, because I'm an efficient market theorist. So I believe the markets already own all the information that's available and it's already priced in. So, I don't really care about, like, a macro view to me is after the fact, it's old news. It's just like something that's, it's history already. But if you want my view of what's going on now in the world, I think we have reached a level of capital. I think we've reached a level of capital concentration in a very few stocks, in a very few hands, which is extremely dangerous. You know, we have 20 trillion, not billion, $20 trillion in the hands of 5 firms. We have, you know, almost close to $10 trillion in market cap in 6 or 7 firms. You know, we have 2 firms that are approaching 2 trillion, in Amazon and Apple, both over 2 trillion, basically, together in average, and then a handful of other firms to take us to 10 trillion. There's an amazing concentration of wealth at the top of the funnel. There's also been a concentrated effort by the Fed and the central banks, you know, obviously to keep interest rates low, even though I don't think that's relevant. I think what is important about that is, again, it's a concentration of risk that has not been spread around over the last decade, and especially since COVID and since the pandemic. So to me, I think the market is at a very interesting level here. There's also been a fairly large divergence between the tech stocks and the financials, and the tech stocks and the small cap stocks. So at this current time, I don't like the market. I think the pot odds favor a much bigger risk to the downside than they do an opportunity to the upside. If I was going to be long anything here, it would be the Russell, which has underperformed relative to the NASDAQ and the S&Ps. So the small cap stocks have underperformed. But in general, I don't think anything, I think only 2 sectors are cheap to me. One is the Russell a little bit, and the other is China. And some of the quote emerging markets or Asian markets, they seem cheap relative to US markets. But other than that, almost everything, including most commodities, seem very expensive to me. Bonds seem expensive, gold seems expensive. Digital assets, I'm a little bullish on. So digital assets, China and the Russell, I'm okay being long. Everything else, I'm pretty short. So across the board right here, I'm short, and I plan to stay short because I like the pot odds to the downside.
So we'll just go through these 2 questions from the chat. And also, I mean, it's 7:55. I'm not sure what time you have to go.
I got a few more minutes left. I was planning to go to 8, so keep going.
Okay. So we'll go, if you could just quickly answer these 2. So first, what is the best way for retail traders to backtest?
Oh, all right. Good news, man. Thomas, we are launching a brand new backtesting app next week. It's called the Look Back app, and it's completely free. It's real time. We've been building it for the last year. It's awesome. And we're launching it on tastyworks and through the Tasty Trade website. So even people in Canada and things like that can use it. If you have a username and password to Tasty Trade, which is free, you can use it. And if you have an account at Tastyworks, you can use it there. It's called the Look Back app. You can test any strategy with any underlying that you want. And I think the data goes back to 2000, but don't hold me to that. But it's an amazing piece of technology. Like I said, we've been building it for the last year. We're about to roll it out. You can backtest anything. You'll have it by the end of next week. It's called the Look Back app.
That's awesome. We're very excited. Piggybacking off of what we were talking about earlier, you mentioned digital assets. Here at PK, we're huge fans of cryptocurrencies.
Yeah, me too.
We've been in crypto for quite some time now, and we've loved the technology that's come out of the crypto space.
I agree with you.
Some of those bigger projects like Cardano, and we were just trying to gauge, what you think about the crypto industry, and maybe give us some thoughts on some of your favorite projects.
So I am overall a bull on digital assets. I don't like to call them cryptocurrencies because I think you're doing a disservice to the product themselves, because I don't think they're really currencies. I look at them as assets. I don't ever see them necessarily being transactional in a traditional sense, but I see them acting and performing as assets in a traditional sense. I'm bullish pretty much across the board, but I'm having trouble differentiating like the various coins. It's hard, and the various tokens. That's a little hard for me. I'm fascinated by certain tokens. I did the first interview ever with, the founder of Ethereum, Vitalik Buterin. I did his first interview when he was in his mom's basement when he was 17 years old. And I didn't even believe a word he said, so I didn't buy a one lot, and I'm kicking myself for that because it was like 20 cents or 25 cents at the time. I was on a call today trying to set up, getting in touch with Charles Hodkinson, who's he's the Cardano founder. I watched the Lex interview with the 5-hour interview with him a couple of weeks ago. I don't know if you saw it. It's pretty amazing. He's a freaking genius.
We're all in Cardano here.
Yeah, I mean, we don't support Cardano yet on Tasty because it's a different blockchain. So we own a crypto company in Chicago called Zero Hash, and we're the largest shareholder, and we are getting our Zero Hash guys to write to Cardano. It's just, like I said, it's a separate blockchain. So we're writing to it so we can support it on the tastyworks platform. I'm fascinated by that guy. He's a little too smart for me, so I'm trying to I have to go back and Google like a lot of things he says so I can really understand it, because he's a little over my head. But I am really fascinated by what they're building and how smart they are, and potentially what the future brings. Currently, I'm long Bitcoin, Ethereum, Litecoin, and Polkadot. Those are my 4 longs. But I don't really have other than my biggest position is in Ethereum. But I don't know why I'm long one and not the other, to tell you the truth. I haven't figured that out yet. I want to buy Cardano because I've listened to him, but since we don't support it yet, I haven't bought it. So the bottom line is, I feel like at some point in the next couple of years, the digital asset world will reach into almost everything we do in different ways. And nobody will escape the tokenization of what's happening globally. It's impossible, because it's apparent to me that we are going to be cutting out the middlemen, which is essentially the large banks and large financial institutions that have been ripping off customers for decades on currency conversions and on money transfers. And it seems to me so easy to use digital assets to accomplish that. It also seems really easy for digital assets to avoid a lot of the regulatory burden that comes with exchanges and data fees and all this other stuff, so we can lower costs all around. I just don't know how quickly the US regulators, the Canadian regulators, the UK regulators, the Chinese regulators will buy into it. So I think you're going to see a lot of regulatory battles coming up. All I can tell you guys is that, right now, Tasty is the only brokerage firm in America that supports all products. So for example, you can trade crypto at Coinbase, obviously, and you can trade some cryptos at Robinhood, but you can't trade futures at Robinhood or futures options. You can't trade anything other than crypto at Coinbase. At Tasty, you can trade everything. We have 13 tokens on the platform, and we'll be adding probably 4 to 10 more over the course of the next couple of months. And people have embraced it. And, we don't offer all the bells and whistles yet, and maybe we will, and maybe one, I don't really know, but easy access, capped commissions, all that kind of stuff's pretty cool. Bottom line is, Ivan, to your question, I'm a bull.
Awesome.
Yeah. So we don't want to go past with your time. We just have one kind of last question
Sure.
from a member, and I'm sure we're all curious about this. So what's the most important lesson you've learned in trading, and what advice would you give to us all, mostly young people embracing into the trading space?
So regardless of what anybody tells any of you guys, don't listen to their bullshit, because they do not know. I promise you, you guys are doing the right thing. You're not doing dumbass speculation, like a Robinhood kid or something like that. You're doing the stuff, you're learning strategy, you're learning decision making, you're learning the right approach to complex, financial and derivative products. It's something that will be with you forever. You will never give this up. You'll be doing this in some capacity, some way for the rest of your life. You'll be way ahead of other kids your age when you graduate school, because your ability to talk about things and differentiate yourself, like talk about implied volatility, talk about expected move, talk about things, is a huge advantage. And I've seen this now for many years. So I would say that my advice to you is to keep doing what you're doing. Don't think like at 19 you're going to create like a shitload of wealth and you're going to all of a sudden be like some gazillionaire, because that's not going to happen. But at 19, what you can do is you can learn a foundation that can support you, and essentially you can build off and create huge wealth in the next 10 or 20 years because of the foundation, the right foundation you create when you're 19, 20, and 21. So my suggestion is just keep doing what you're doing. It's great.
And I see in the chat, Noel, we'd love to discuss the crypto with you in our Discord. Feel free to bring up some points, we can discuss that. I just want to thank Tom so much for coming out. We all found this so valuable.
Well, you guys have an open invitation. You can, this is great. I mean, I love doing this. It's like I said, I'm a junkie. I do this. I did 4 chats today. So, and I do it because I love it. Not because, it's what I do. But you can reach out to me anytime. My email is tom@tastytrade. Anybody has any questions, just send me a note. And like I told you guys, when you're ready to, when this COVID thing's a little more over and in the fall or something, plan a trip, come on downtown, I'll take you out to lunch and we'll bullshit, we'll talk markets.
We'll do it. Awesome.
And, to everyone else, I just wanted to let you guys know, this was our first speaker of our monthly series, and you'll be the first to hear it, that our next speaker in August will be Gregory Mannarino. So we're also super excited about that, to hear about what he has to say. That should be another awesome discussion in August. So I just want to thank everyone for coming out. And again, Tom, thank you so much.
All right, guys, take care.
All right.